The same market, 4 different situations. Imagine there is a small town called Anandpur. Every Sunday, the people of Anandpur visit the same market. One Sunday, something unusual happens. The shopkeeper says, everything has become more expensive. The following year, something completely different happens. The shopkeeper says, prices are actually coming down. Then another year, prices continue increasing, but much more slowly. And finally, the town faces its worst situation. Prices are rising, but businesses are struggling. Production is weak, and jobs are becoming difficult to find. 4 different situations, 4 different economic concepts: inflation, deflation, disinflation, stagflation. Let's understand them through the story of Anandpur. Situation 1. Inflation. Let's go back to the first Sunday. A family enters the market with 2000 rupees. They buy rice, vegetables, milk, cooking oil, soap. Last year, the same basket cost 2000 rupees. This year, it costs 2200 rupees. The family notices that many goods and services have become more expensive. The important point is not that one particular item became expensive. The important point is that the general price level is rising. This is inflation. Inflation is a sustained increase in the general price level of goods and services over time. So remember, inflation is equal to general price level increasing. Situation 2. Deflation. Now imagine Anandpur faces a completely different situation. People become worried about the future. They start spending less. Businesses sell fewer products. Demand becomes weak. Shopkeepers begin reducing prices to attract customers. That 2000 rupee basket that once cost 2000 rupees now costs only 1900 rupees. And prices continue falling across the economy. This is not simply one shop giving a discount. The general price level is falling. This is deflation. Deflation is a sustained decrease in the general price level of goods and services. So, deflation is equal to general price level decreasing. And remember, falling prices may sound good, but prolonged deflation can be dangerous because consumers may postpone purchases. Businesses may reduce production and investment, and economic activity can weaken further. Situation 3. Disinflation. Now let's change the story again. Anandpur's prices are still increasing. Last year, the family paid 2000 rupees. This year, 2200 rupees. That's a 10% increase. But the following year, the basket rises from 2200 rupees to 2310 rupees. The price level is still increasing. So has inflation disappeared? No. Has deflation occurred? No. Something else happened. The rate of increase in prices has slowed down. Inflation has fallen from 10% to 5%. This is disinflation. Disinflation means a reduction in the rate of inflation while the general price level continues to rise. This is one of the most important distinctions in economics. Inflation. Prices are rising. Disinflation. Prices are still rising, but more slowly. Deflation. Prices are actually falling. Situation 4. Stagflation. Now Anandpur faces its most difficult situation. A major shock hits the economy. Businesses face higher production costs. Factories reduce production. Some businesses stop expanding. Job opportunities become harder to find. Economic growth becomes very weak. But strangely, prices are still rising. Food is becoming expensive. Transport is becoming expensive. Production costs are increasing. So Anandpur has weak economic growth, high or persistent inflation, high unemployment or weak employment conditions. This unusual combination is called stagflation. The word itself gives us the clue. Stagnation. Flation, inflation. Stagflation is a situation in which an economy experiences persistent inflation alongside stagnant or very weak economic growth, often accompanied by high unemployment. Now look at the 4 situations. Let's return to Anandpur's market. Situation 1. Prices are generally increasing. Inflation. Prices increase. Situation 2. Prices are generally falling. Deflation. Prices decrease. Situation 3. Prices are still increasing, but the rate of increase is slowing. Disinflation. Prices increase. Inflation rate decrease. Situation 4. Prices are rising while economic growth is stagnant or very weak. Stagflation. Prices increase. Weak economic growth. The biggest confusion. Disinflation versus deflation. Suppose inflation falls 8%, 5%. Are prices falling? No. Prices are still increasing. The increase is simply slower. That is disinflation. But if the general price level actually starts falling, deflation. So remember, disinflation means prices are rising more slowly. Deflation means the general price level is falling. One final story to remember everything. Imagine Anandpur's market notice board. Inflation. The prices on the board are moving up. Deflation. The prices on the board are moving down. Disinflation. The prices are still moving up, but the speed has slowed down. Stagflation. The prices are moving up, while the economy itself is barely moving forward. Remember forever. Just remember these 4 sentences. Inflation is equal to prices generally rise. Deflation is equal to prices generally fall. Disinflation is equal to prices still rise, but more slowly. Stagflation is equal to inflation plus stagnant or very weak economic growth. And the most important distinction, disinflation is not equal to deflation. Disinflation, price level, but inflation rate. Deflation, price level. Once you understand that difference, these 4 concepts become much easier. Understand once, remember forever.